Welcome back to 6-Minute Strategy after a short summer break. Equities have rallied strongly this year to date, while most other asset classes have either retreated or are treading water. Bond markets have sold off around the world, with the US 10-year yield now at 4.7%, the highest of Trump's second term. Hardly a vote of confidence in Kevin Warsh, the new chairman of the Federal Reserve. UK gilts have risen to 5%, well above the levels recorded even during the darkest days of Liz Truss's short-lived government. The biggest sell-off, though, has been in Tokyo, where yields have risen to 2.7% in 2026 alone. The uniquely strong returns from equities against this backdrop have been underpinned by an extraordinary show of strength in corporate earnings, with the US now heading for a 7th consecutive quarter of double-digit earnings growth. So, are we entering a new Goldilocks world for equities, one in which there is enough growth to support earnings, but not enough to trigger material interest rate rises? We'll look at that question and what it could mean for your portfolio in the slides ahead. So let's begin by looking at the performance of global equities in the left-hand panel for the year to date. You can see that grey line showing the strong rally despite the Iran-US war. The red line below, the quality index, also catching up after a very strong underperformance in 2025. This is companies with strong balance sheets and particularly sustainable margins. That's encouraging for a broadening of the markets generally, and of course it helps our thematic approach here at Saracen. On the right-hand panel, I'm showing global equities there up 14% against a series of other asset classes, the US dollar, gold and UK 10-year bonds, total return. Taken together, they're all about flat for the year. So 2026 has been an equity story. So why is this and can it continue? On the left-hand panel, you can see that the global growth expectations are strong. The underlying economy, particularly in nominal terms, is really supportive of profits. G7 leading indicators have ticked into the expansionary territory, while the famous US ISM survey, where a number above 50 indicates expansion, is very strong for US manufacturing at 55.6, and strong also for the service sector at 54.1. So high confidence that this growth rate can continue. On the right-hand panel, you can see fund managers agree in the big Bank of America Fund Manager Survey. They asked survey members whether they saw no end to this expansion, as well as no landing at all. And interestingly, 54% said yes, the highest I've seen recorded in this survey. Only 2% of fund managers forecast a hard landing or recession. So those economic numbers supported by fund managers and industry surveys. The exception, of course, is probably China, where the hangover from the property market still weighs heavily on the economy. You can see in the left-hand panel, fixed asset investment, that's primarily building and construction, that's shrinking, and the red line at the bottom there, retail sales, running at just 1%. That's a very weak number. Another way of looking at it is to look at loan growth. The red is for loan growth for corporations, and the blue is the loan growth for private individuals. And you can see that just recently, that loan growth, that blue bar, has moved substantially negative, almost to the lows we saw during the COVID crisis. You know, the Chinese consumer is very conservative. They're buying buffers, really, of liquidity in their own portfolios as a hedge against the weakness in the underlying economy. Now, this, of course, means there's a huge emphasis on exports, and we're seeing a flood of cheap goods, particularly autos across Europe and the rest of Asia. That's, of course, helpful in keeping inflation down, and that weaker economy, too, has meant that oil prices are lower than they might otherwise have been at this point in the war. Moving to oil prices themselves, you can see for the third reason that underpins these equities is that real oil prices, that's oil adjusted for inflation, are substantially lower than they were in any of the previous major crises. The Kuwaiti invasion, the Iraq war, the Russia-Ukraine war, and now the US-Iran war. Now that doesn't mean that they're not moving, they're still up 45% year to date, which is a big number, but they're nothing like the level they were in previous crises. Coupled, of course, with the fact that economies today are much less oil intensive. So yes, these oil prices around $90 are painful, but they're not doing the sort of damage to the global economy you've seen in previous cycles. Finally, of course, central bankers are being generous. They're allowing most of the developed world to operate with either very low real interest rates or actually negative real interest rates. While the emerging world, Brazil, Colombia, India, have to face much higher real rates, everything really, Switzerland, Taiwan, Canada, Japan, Singapore, etc., all running at negative or zero real interest rates. And that's very supportive. Now, of course, we have to see where the new governor of the Fed Chairman Warshko's. His presentation was quite opaque last week, but I think the possibilities of US interest rate rises still remain with us, but the odds are probably on a hold at the next meeting. So let's wrap this all up. What's driving equities is solid underlying earnings growth. And you can see in the panel below that expectations for 1 year ahead earnings have risen to a staggering 33%, and revisions continue to be positive despite the impact of the war. Now, things could go wrong. Inflation could be more persistent. AI returns could not justify the massive levels of capex today. And of course, with so much funds being raised by governments and the private sector, there could be a liquidity squeeze. We don't think these underlying earnings are robust, they're repeatable, and they're expanding out into areas of the market that are not purely AI dominated. And this is an encouraging platform to build a quality portfolio with a thematic overlay in the months ahead. Thank you.